Good morning and welcome to our next meeting of the May Revenue Estimating Conference. This morning we will be hearing from the state's economists from IHS Markit, and later today some testimony on revenues from the Accounts and Control and the Division of Lottery. So we're going to start today with James Bonnecker and Michael Lynch from IHS Markit, who are going to give a presentation of the U.S. economic forecast and Rhode Island specific, and I'm going to turn it over to them. Thank you.
Good morning, this is James Bonnecker with IHS Markit. I'll be presenting the U.S. economic macro outlook.
And I'm going to go ahead and share my presentation deck with you all now.
For anybody watching, this is also available on the General Assembly's website under the May Revenue Conference page, all the materials being presented today. Thank you.
Could someone just confirm that this is viewable?
You should probably try and do full screen. It's I think if you run the presentation view, it may not show that sidebar. I'm just not sure exactly how to do that.
Does anyone have any advice on how to make this full screen?
Why don't you just go with the double squares, and unless we get some quick way to fix it just to make it easier. So we don't.
Okay, I'll go with that.
Your other option is to do it in PDF.
Oh, I don't have one of those available, unfortunately, so let me. Hang on, I apologize for this. Okay, I'm going to go ahead and get started. Hopefully you all have these materials, and so if you're unable to see as large as we'd like, then I apologize for that, but I'm happy to answer any questions at the end of this. And so I'm going to be presenting the U.S. macro outlook. So the outlook has improved materially over the past several months, largely owing to improvement on the public health situation with COVID-19, with the improvement of the vaccines that have been distributed to many Americans, somewhat ahead of schedule that we had assumed back in the fall, and then also due to the large amount of fiscal stimulus that's been aiding households primarily to get through the pandemic and the economic recession that was associated with it. So this has led us to upgrade our outlook, at least in the near term, but it is also characterized by the fact that we are still in the middle of a pandemic, and there are some lasting effects of the pandemic on the economy going forward. So I'm going to talk about some of the high frequency indicators that we're looking at right now and how that's shaping our outlook for the U.S. economy over the next couple of years. So we have to start with the COVID-19 situation, and fortunately the situation has improved this spring. You can see that the number of U.S. COVID-19 cases and deaths are pretty much back to where they were prior to the fall of last year when we got that big surge. in terms of cases and deaths. So that's obviously a big positive for the human condition in the U.S., but also the economic outlook and performance that we're seeing. So this is allowing green shoots in the economy, primarily in the consumer sector, and is a definite positive for the strength that we've seen over the past several months. The other big development is the number of people that have been at least partially or fully vaccinated in the U.S. And so this chart on the right shows that as of April 15th, about 38% of the population in the U.S. had was at least partially vaccinated with the COVID-19 vaccines. And that number is even higher today. But if you were to just project that out, assuming that everyone who was able to get the vaccine did go ahead and get it, then by July, that trend would mean that 90% of the US population would be vaccinated by July, which is about 6 months earlier than we had assumed with these figures about 6 months earlier back in the fall. Now, that doesn't mean that we're expecting 90% of the population to be vaccinated. It just means that based on the current trends we're seeing with the number of people being vaccinated, that trend is a sharp acceleration from what we previously expected. Now, one of the things that this has meant is, especially in the consumer sector, for services that were the hardest hit during the pandemic, things that necessitate social proximity to other people, such as travel and entertainment, those sectors are still very much beleaguered by the effects of the pandemic, but we have seen rapid improvement. And so the first chart on the left here shows the number of seated diners at U.S. restaurants, sourced from OpenTable, the reservation platform. And you can see that starting in February, the numbers of seated diners at U.S. restaurants just really took off in an upward trajectory and have slipped a little bit. I think part of the volatility you see in the last couple of weeks there is due to around the Easter holiday. But certainly the trend in terms of the number of Americans dining out, which is a pretty good proxy, I think, for most sort of social activities in the consumer services sector, has improved quite dramatically. However, we are still about 20% below where we were 2 years ago prior to COVID, and so still a long way to go by all means. Same sort of developments we've seen in the number of airline passengers through U.S. airports. So the TSA checkpoint travel numbers, kind of around the same time in mid-February, started to take off, and especially in March, the number of travelers were climbing quite quickly, probably around spring break holidays and warmer weather, and of course with the improvement we saw in terms of the number of COVID cases and the vaccine timelines as well, especially with older Americans getting vaccinated earlier and able to travel over the early spring holidays. So, but again, you can see that we're still more than 20% below what the 2020 average was in January of 2020 prior to COVID wreaking havoc on the travel industry. So positive trends, but not out of the woods yet. And consumer spending more broadly has also really been surging. We've seen somewhat of a mini boom in consumer spending over the March period especially. So this data is compiled from Opportunity Insights Economic Tracker, which actually compiles daily consumer spending data. We've translated that into weekly data here. It shows consumer credit and debit card spending relative to January 2020, which was the pre-COVID benchmark. And this data shows that consumer spending is 10% above that level prior to COVID. So certainly the influx of money that we've gotten from stimulus, the improvement in terms of the COVID situation, are all leading to a recent surge in terms of consumer spending more broadly, not just on things such as travel and entertainment. And then in the broader economy, outside of the consumer sector, the New York Fed Weekly Economic Index takes into account not only consumer spending, but things like manufacturing, production, the labor market situation. The Weekly Economic Index from the New York Fed is showing economic activity consistent with about 10% 4-quarter growth in GDP. And so what that's saying is that where we are in April, based from now versus last April, the U.S. economy has grown about 12%, or excuse me, 10% in this latest few weeks. And that's roughly consistent with what our forecasts, our quarterly forecasts are showing. So this is a way of corroborating what the high frequency data are saying about what's going on in terms of current economic activity, and this supports our forecast as well. And then so, yes, we've seen this strong surge in activity over the first few months of 2021, but is it going to last? And so one of the indicators we look at for sentiment from Purchasing Managers Index, essentially business leaders in both the manufacturing sectors and services sectors, what are they saying about conditions over the next 6 months? And so a reading over 50 here indicates expansion, and you can see that over the past few months, even dating well back into the second half of 2020, purchasing managers were increasingly optimistic about the budding economic recovery. So this includes things like, do you expect to hire more people over the next 6 months? Do you expect the number of orders to increase, and other measures of financial stability and performance? So on the business side of things, business leaders are feeling confident. They're seeing improving activity and expect that to continue well into the later parts of this year. So a very good sign. So circling back to the COVID situation, just because we need to think about what the number of cases are going to do, and equally as important, how containment measures are going to be eased or strengthened over the coming months. And so the containment index that we've come up with is a GDP weighted index for all of the US states, including, and our attempt to quantify what's going on in terms of containment measures and restrictions on business activity. So this would be things like the number of diners at restaurants or certain types of events being limited in capacity. And so basically, we're still at an elevated level, but the containment index has begun to ease more meaningfully over the past several months, as many states around the country have lessened up on their restrictions for businesses. And that allows a quicker return for consumers to engage in many of these activities at the same time that we have seen lower number of COVID-19 cases and increased vaccinations. And so we expect this to continue over the spring and summer months. So the other big developments in terms of how the forecast has changed in the past few months, we've seen a tremendous amount of fiscal policy support. So going back to 2020, we had the CARES Act in March of 2020, which was the first sort of rescue relief under the Trump administration in response to COVID. And then toward the end of the year, we had the Consolidated Appropriations Act back in December, which resulted in January stimulus checks. So those were already baked into the forecast. And then the Biden administration, one of the first things that they did was the American Rescue Plan, which was the $1.9 trillion stimulus just enacted earlier this year, which resulted in large amounts of stimulus checks, the $1,400 to qualifying Americans, extension of emergency unemployment programs that were put in place last year through early September, including the enhanced unemployment benefit of $300 a week, which was previously $600 a week last year, but still a sizable support for unemployed persons. Of course, there was also a significant amount of state and local government aid, $350 billion, and then other funds dispersed for education and COVID mitigation efforts. So this was the largest stimulus in terms of the consumer sector that we've seen. The $1,400 checks has really elevated household savings and spending as well. So I'll talk about that in the next couple of slides. In terms of other policy, the forecast does not include President Biden's American Jobs Plan, which was introduced last month, which is a plan to spend $2.1 trillion on social investments, partially infrastructure, also to be paid for by higher corporate tax rates. So I do have a slide on our preliminary estimate of that bill, but it is not in the forecast yet. So only fiscal policy that has already been enacted is part of this forecast. Strong revenues reinforced by the ARP limit the usual cyclical state and local fiscal contractions that we saw, for instance, following the Great Recession. So state and local employment rebounds quite strongly as schools reopen, which is a key component of the outlook. And in terms of in terms of monetary policy, the Federal Reserve is expected to maintain its policy rate near zero until middle of 2024, and which at that point they will have expected to see maximum employment and inflation above 2%. So very strong fiscal and monetary support over the next several years. So how does the stimulus checks, how does that inform our forecast? First, let's take a look at just visually the sheer size of the stimulus checks that were dispersed as part of this ARP plan. So March is going to be the gray bar just to the left of the vertical line here. You can see that injection of money. Those stimulus checks arrived almost entirely on the single date of March 17th. And some of the funds did trickle out over the course of March and April, but it primarily arrived in the middle of March, which is one of the reasons we've seen such a strong rebound in terms of retail sales and consumer spending in March. Those funds that were spent quite quickly. And so that's one of the reasons that's led to the near-term upward revision in terms of the forecast for consumer spending and GDP growth. And so the previous chart was showing the actual size of each of those, both the emergency UI benefits and the stimulus checks. This is our translation into consumer spending in our forecast, how we expect those funds to be spent. So for the emergency UI benefits, the green bars, we essentially make the simplifying assumption that those are spent over a longer period because people who are receiving those benefits treat those more like labor income. Whereas people who receive the stimulus checks spread their spending out over the course of several months. And so it's not a perfect estimation, but our assumption is that those stimulus funds are spent over the course of 5 or 6 months, with the remainder being saved or used to pay down debt. So our assumption, based on empirical work that we've done in the past, is that only about 15 to 20% of the stimulus funds are actually spent. The rest is saved or used to pay down debt. And so just to dig into that assumption a little bit more. So one of the exercises we did was to look at excess personal savings. So this is a measure we came up with to say, all right, well, if the personal saving rate in the US were the same as it was averaged over the last couple of years prior to COVID, how much extra money do households have at this point, just to get a sense of what we're working with here. And so even through February of 2021, before we got the March stimulus, excess personal savings were measured at about $1.7 trillion. So in other words, that's a lot of extra money in household savings accounts that either is going to be saved permanently or spent over the course of some period of time. And so our thought, based on theory, is that consumers treat these stimulus checks as sort of more of a wealth endowment rather than labor income. And we know that marginal propensity to consume on wealth is much lower than it is on labor income, leading us to the result that most of these funds will be saved rather than spent. And there's a great dispersion based on demographics, where people fall in the income distribution. Low income earners tend to have higher propensities to consume. Higher income earners are more likely to save these funds. But on aggregate, at the macro level, like I said, that marginal propensity to consume is only around 15 to 20%. over the course of 6 months. So, of course, we've never really had anything like this COVID situation in history. Not only the COVID pandemic, but also the extraordinary amount of fiscal support. And so the closest historical example we have to look back on is World War II, where we saw a huge spike in the saving rate, up to close to 30%. And then after the war, when people came back and started getting back to work, the saving rate came down, but not all the way to its previous level. And so that's very consistent with our outlook that the saving rate that's elevated now will come down, but not all the way to its full level. Another way of saying that some of those funds that have been dispersed will be saved more so than spent. So where does this leave us in terms of our forecast for GDP growth and consumer spending growth? So consumer spending is the real mover here, given that was the epicenter of the impact from the pandemic. And so consumer spending is already on track to pass its prior pre-COVID level at some point in 2021, most likely in the next quarter. And that's much faster than we previously expected. So our GDP growth forecast has been revised up over the past couple of months. We're currently, as of this forecast, expecting year-on-year annual average growth of 6.2%, which is right in line with the consensus forecasters, other forecasters out there, and then for growth of 4.3% in 2022. So in terms of consumer spending, COVID-19 really turned things upside down in terms of what people are spending their money on. And so almost immediately in the few months after the worst of COVID-19, by the summer, goods spending was already fully recovered as people sought out to buy more automobiles, furniture, household goods, anything online that they could, all of those sorts of things, while services just absolutely tanked and has been quite slow to come back until the last couple of months. And so we don't see that fully coming back to more of a normal composition until at least 2022. And the reasons for that are, yes, we're seeing leisure travel start to come back. We're seeing sporting events slowly start to come back, but we do expect that it will take some time to reach full capacity at some of those types of events. We've also seen companies go out of business in the restaurant industry. Something like over 100,000 restaurants have already been estimated to be permanently closed. Also, international travel is going to be subdued for some time. Business travel is likely to be subdued for some time. And so it will take time for that composition of consumer spending to get back to a normal mixture. But we do expect that to happen. So the labor market, this is something to keep an eye on. You can see that the blue line here shows the number of permanent job losses versus the green line is temporary layoffs. So this is something that the BLS has been tracking, and you can see that as of March, over 3.5 million estimated permanent job losses in the US. And that pales in comparison to the peak of the Great Recession, which was 6.8 million. However, 3 million is a lot of jobs that are estimated to be permanently lost. And so that's going to take several years for us to get back to full employment. And then I think to look at the sectors of employment also is pretty eye-opening. When you look at leisure and hospitality, the number of job losses is just tremendous. So this shows 12-month change in the number of payroll jobs. For leisure and hospitality, there's still a 2.4 million job deficit. And this actually undersells the pain here a little bit because it's comparing versus March 2020 when COVID had already resulted in some job losses, especially in the leisure and hospitality industry. But really across the board, we're seeing many people have been displaced from employment, some of them unlikely to come back anytime soon. So this could be a weight on overall not only job growth, but GDP growth if firms, especially if they're unable to hire enough workers to meet the demand, which it seems like is coming back quite quickly in many sectors. You may see some hiring shortages in several industries. So quickly about the housing market, this is, for lack of a better word, the housing market is sizzling hot. US home prices have been record-breaking over 2020, which going into this, you might not have had expected, given the severity of the recession that we saw. But it's changed consumer preferences. People who were on the sidelines thinking about buying a home anyway realized that they really would like to have extra space for an office or to homeschool their children, and some of the other complications that have necessitated more space during stay-at-home orders. And so this has really caused quite a spike in terms of house prices due to the limited amount of housing inventory that is out there pretty much throughout the country, but especially in markets that were already growing quite quickly. So in terms of housing permits, the construction industry has responded pretty sharply in 2020 and early 2021. This is more of a makeup for lost time of construction that was probably already going to take place earlier in 2020 or later in 2021. And so this isn't really a permanent sea change in terms of the amount of housing construction that we expect. It's more just making up for lost time earlier last year and then perhaps taking some construction out of what would have happened in 2022. So it's good to see that the building has been strong, but we don't expect that to be a permanent change. And really what dominates the housing forecast over the longer term is demographics. And the demographic situation has been pretty poor over the last year, just in terms of overall population growth, especially with lower immigration, more deaths. Even prior to COVID, the number of deaths that we've seen in the US due to opioid epidemic or just other causes has been higher than we had expected, which leads to a pretty modest demographic outlook in terms of population growth going forward. And that's really driving the housing market forecast over the medium term. Durable goods orders, the manufacturing sector is seeing a pretty strong rebound so far, both in terms of their new orders coming in and the number of shipments. We are seeing some more widespread shipping delays lately as several inputs such as semiconductors and other issues in the supply chain have created bottlenecks in terms of manufacturing and shipments. But we expect those to mostly be transitory and that the manufacturing sector will continue to meet demand, albeit with somewhat of a lag and longer delays for the next several quarters. In terms of pricing in industrial materials, commodity markets, we've seen huge surges in terms of pricing for things such as lumber, especially. So that's one thing that has hurt housing construction. Even though it has been strong in the last couple of months, the increase in lumber prices and other inputs is weighing on production, not just in the housing industry, but all across the economy. We're seeing inflation in some of those producer prices. A lot of that's due to demand snapping back faster than I think many people anticipated. And so manufacturing firms, production have been slow to respond to that, but eventually that will work itself out. So in terms of inflation, we feel that this will be passed on to consumer prices in the near term. So this year we are expecting inflation definitely above 2%. But remember that last year during COVID, it was well below 2%. And so We view these as transitory and more of caused by base effects from low prices last year and higher prices this year as makeup for that. So more of temporary price increases rather than a long period of high inflation. And this chart illustrates that. You can see that in just to the right of the vertical line here, in terms of the PCE deflator, both core and overall, those are going to be above 2% for a very brief period, and then fall slightly below 2% and for the next couple of years, and then gradually move above 2% over probably not until 2023, 2024. One of the reasons that inflation is not higher in our forecast is because we have a rather strong outlook for the US dollar exchange rate compared to other currencies, which gives the US stronger purchasing power and lowers input prices, and that in turn puts downward pressure on consumer price inflation. So that's an offsetting factor to some of the supply chain bottlenecks and other issues that are causing temporary increases in certain prices. And then circling back to monetary policy a bit, because we've talked about the labor market and how it's still got a long way to go, and we've talked about inflation and how it's not really threatening over the medium term, at least not in our baseline forecast. What that leads us to is monetary policy that is extremely lax until 2023, 2024. We expect that the Fed won't raise interest rates until the middle of 2024. The Fed has communicated quite clearly that they need to meet several criteria in the actual data before even raising interest rates. So those are that the US has achieved maximum employment. So in all likelihood, that means an unemployment rate consistently at or below 3.5%, which is where we were prior to COVID. And that inflation is consistently above 2% and forecast to stay above 2% for some time. So given that all three of those are unlikely to happen anytime in the next couple of years, we think the Fed is more likely to wait longer until they're very certain that the economy has made it out of the recession completely, that the labor market is completely healed, and that inflation is finally moving at or above 2%. That is my last real slide on the baseline forecast. I am just going to take one moment to note our preliminary assessment of the American Jobs Program. Again, this is not yet reflected in our forecast. There are some political complications. It may be scaled back, the original proposal. So until that becomes more clear, we're not going to include this in our forecast. The AJP has been referred to as an infrastructure bill. However, only about a third of the spending that's allocated in that bill is for transportation projects that you would conventionally consider infrastructure. There's some other social investments in there that things such as supporting electric vehicles, domestic manufacturing, R&D, job training, and et cetera. So it's a very broad bill. It's not conventionally an infrastructure bill, but there are infrastructure components in it. So our initial estimates suggest that the ramp up in spending from this American Jobs Program, if passed as it was presented, could raise GDP growth by between 0.2 and 0.4 percentage point for several years, resulting in the level of GDP being about 1% above our baseline forecast by 2024, and an unemployment rate below 3%. So essentially, we're looking at a half a percentage point on the unemployment rate and 1% in terms of GDP, level of GDP through 2024. So not a huge change from the baseline forecast. One of the reasons is that this would likely result in higher interest rates in financial markets. And of course, there's some offsetting impact from higher corporate taxes as well. So this just kind of visualizes what I laid out there. It breaks down sort of the budget effects that we've seen in terms of outlays and revenues that have been laid out. Again, this is likely going to change before it even goes through Congress. So don't put too much stock in this, but if you are looking for risks to the upside or downside, this would be an upside risk in terms of the medium-term growth outlook for the US. Another upside risk is that the excess savings chart that I showed you, we've taken a pretty modest approach to estimating the marginal propensity to consume out of excess savings. And so it very well could be higher over the near term, and more Americans could unleash that pent-up savings from their savings account and put it back into the economy. In terms of downside risk, I think it's likely to be inflation. In addition to the situation in terms of COVID-19 and hesitancy among Americans to get the vaccine. There's some surveys that show up to 30% of some religious and political cohorts are definitely not going to get the vaccine, which could lead to another surge in cases, particularly if we see some of these foreign strains, mutations in the virus that are resistant to the vaccines that we have, that could result in another downside scenario on the healthcare front. And so that's really the US outlook. I'm going to pause and I will take questions or pass it to Mike.
How about we go to the Rhode Island forecast and then save our questions for both? Does that work for you, Jonathan? I can't hear you, so I'm going to assume that works for you. Huh?
Did you hear me? I'm sorry. I said that was fine.
Okay, thanks.
Yeah,
No,
maybe I messed that up.
That's okay. Thank you.
Yep. Okay, good morning, everyone. Thank you, James. And now I will just try to get my slide deck shared here in a moment, and I'll begin with the Rhode Island outlook. Okay, are my slides now visible?
Yes, we can see it. Oh, yes. Yep. Thanks.
Okay. So to begin with my discussion of the Rhode Island outlook, I'll just begin with an overview of the benchmark revisions to employment data that were released last month. So in that new data, the total employment count for December 2020 was revised down by about 4,100 positions from about 461.9 in thousands in the original data to slightly below 458. And those revisions impact on the 2020 employment growth trajectory for Rhode Island, pulled down year-over-year growth in December from a 8.7% contraction to a 9.3% contraction. Meanwhile, the Rhode Island unemployment rate for December was actually revised down slightly to 7.9%. Compared with 8.1% in the initial estimates. This downward movement in the unemployment rate, despite the weaker economic picture presented by the revised employment count, is largely attributable to a downward revision in the state labor force count. As for the sectors receiving the most substantial revisions, the largest downward revision was reported for healthcare services, which saw its December count revised down by 2,200 positions. Also receiving some of the larger downward revisions were education services and retail trade, as both saw their payroll counts marked down by about 1,300 positions. and then followed by real estate, rental, and leasing with a downward revision of about 1,200 positions. As for notable upward revisions to the employment count, both the administrative support and accommodations and food services sectors were revised up by more than 1,000 positions each. And that upward revision in the latter, which covers the hospitality industry, was particularly good news given how hard that industry was hit during the pandemic recession. Now, to shift the focus to tracking the recovery progress. So last year, as the state began its phased reopening, Rhode Island's non-farm payroll count began to rebound in May, and concurrently, the unemployment rate also reached a turning point and began to work its way down from its peak reading of 17.4%. So the slide here provides just an overview of how the recovery has progressed so far in the state labor market. With the graph, it was just depicting non-farm employment and unemployment rate levels, as well as the table showing the monthly annualized employment growth rates. So the first of two takeaways from the graphic here, now that we're well beyond the initial turning point, is the evolution of month-to-month growth during the second half of last year. After a stretch of really rapid employment growth during the initial stages of the recovery, the pace weakened considerably as the year went on, most notably during the fourth quarter as another severe wave of coronavirus cases swept the state. And this slowdown in growth ultimately culminated in a double-digit decline in employment for December. For that month, although most sectors did see a hit to their employment counts in December, much of the damage was once again dealt to accommodations and food services, which accounted for about half of the private sector job losses reported for that month. And then moving into 2021, fortunately, the state did bounce back in January with some double-digit growth, and that would be the second main takeaway here from this slide that I'd like to zone in on. So the next aspect to consider regarding the recovery progress is how far has the state made it? In the 11 months that have passed since the April trough was hit last year, Rhode Island's non-farm payrolls have grown by nearly 68,000 on a cumulative basis. So this amounts to about a little over 60% of the total net loss observed last year between February and April. And in the revised data, that total loss is estimated to be about 108,000 jobs. So in other words, as of March of this year, the state has recouped just shy of 2/3 of the jobs lost to the pandemic recession. However, as our forecast will ultimately show, the timetable for recouping that last third of the losses will be a much more drawn-out process. As for unemployment, the state jobless rate has fallen more than 10 percentage points since its peak of over 17% in April last year. But despite that considerable progress, at 7.1% in March, it remains elevated above its pre-pandemic level of 4% reported last February. On a sector-by-sector basis, those posting the largest gains over the past 11 months were precisely those that endured the biggest losses during the downturn phase last spring. I've got this spelled out in the table at the bottom of the slide, which shows both the net gain for each sector since April 2020, alongside the number of jobs lost during the 2 months of the economic plunge. So leading the way in jobs added is accommodations and food services at over 21,000 jobs added, up against a preceding net loss of nearly 33,000, followed by healthcare with a net gain of 11,000 since last April against an initial decline of 17,000. And then with the third largest net gain since the labor market trough of last year was retail trade, which has shown thus far a net gain of 9,700 jobs versus an initial decline of slightly over 11,000. So for a final portion of my discussion of the state's recovery so far, this next slide offers a slightly different way to look at the labor market climate. This graph here, sourced from the Opportunity Insights Economic Tracker, looks at employment growth performance over time relative to a base period of January 2020. So that fully precedes the onset of the pandemic and the ensuing recession. What makes the metrics depicted here a little different is that employment measures are broken out by workers' wages into high wage, middle wage, low wage employment quartiles rather than by industry. So this data doesn't necessarily contradict what you can glean from sector by sector analysis, but paints a more transparent picture of this underlying dynamic. During the initial portion of the COVID-19 economic decline, employment was hit much harder as the wage scale went lower, ranging from a 20% decline in high wage employment to a decline of more than 50% in the lower wage segment. Fast forward to the most recent readings available, which has data that covers through about mid-February, the experience continues to be more troublesome for employment at the lower wage end of the spectrum. So high wage employment at that point is estimated to be only about 1.7% below the pre-recession peak, while middle wage employment is estimated to still be nearly 11% below the pre-recession peak, and then the lower wage employment as measured here is still estimated to be 25% below pre-COVID peak. And I'll note here that at least this dynamic, at least from a general point of view, is not unique to Rhode Island, as a lot of states, and also in this national data, you'll see similar differing performance across the different employment measures by wage scale. Now, for a few words about the initial batch of population data that was released earlier this week. Per these new 2020 census apportionment population counts, the result is that Rhode Island will hold on to its 2 seats in the U.S. House of Representatives. As a technical aside, that apportionment population includes both the resident population that lives within the state, which is measured by the 2020 census itself, as well as counts of U.S. military and federal civilian employees living overseas, as well as their dependents that are living with them, and that's allocated to the home state. In practice, the gap between Rhode Island's resident and apportionment populations are very small, coming in at less than 1,000 individuals in the 2020 census count. So ultimately, this result came as a surprise to many, as the previously published Census Bureau population estimates, which estimate resident population, hinted that the Census 2020 population count would likely come in lower than what ultimately materialized. So to speak to this issue directly, the highlighted numbers in the table show the 2020 census resident population count alongside the 2020 July 1st, 2020 population estimate, which was published in December of last year. So although the reference period for both of those data points are not exactly the same, the gap between the census count and the initial population estimates is quite large. It's on the order of about 40,000 persons, higher in the 2020 census count than the previous estimate, which is about a 3.8% gap. The initial story nationally to account for cases like this, where the errors were particularly large, is that immigration had been undercounted in the estimates, but was then picked up accurately or more accurately in the 2020 census. But if you look nationwide, state by state, this wouldn't necessarily explain a state like Arizona, which actually ended up being much lower than expected. So there's still much to be understood there. And I'll just quickly note here that these new population counts have not yet been incorporated into the state forecast presented here today, or the national forecast for that matter, which was done a little bit earlier this month. So on to the next slide, just quickly, we have a map here that shows nationwide population growth by state between the 2010 and 2020 census counts. Over that 10-year time horizon, The US population grew by about 7.4%, although Rhode Island came in well below the national average at 4.3%, which is not below average population growth is not not uncommon in the northeast portion of the country, but even at that, it's still ranked 32nd nationally. And for a more regional context, out of the 6 New England states, Rhode Island ranked 3rd, trailing only Massachusetts, which saw 7.4% growth between 2010 and 2020, and New Hampshire, which saw population grow by 4.6% over that 10-year horizon. Now, moving on to the next slide, I'll take a quick look at the state of the residential real estate market coming into 2021. The graph on this slide here depicts the historical data count of total housing starts alongside home prices as measured by the FHFA Purchase-Only Home Price Index. Both of these series took a hit in the second quarter of 2020 during the deepest portion of the economic downturn. The home price index pulled back slightly, about 1.5%, non-annualized, while construction activity slowed substantially, in some cases pausing altogether for some select time periods during that quarter. However, both did rebound solidly with a strong second half of the year. Housing starts bounced back to nearly their early 2020 level, while the purchase-only home price index rose more than 5% in both the third and fourth quarters of the year, to close out 2020 up over 13% year over year as demand for single-family homes surged. For comparison, the FHFA index for Massachusetts increased 11.2% in the fourth quarter, and the national index rose 10.8%. So home price growth in Rhode Island outpaced both Massachusetts and the national average. So in late March of this year, the BEA released a new set of state personal income historical data. This release included the first subnational history through 2020 Q4, which gave the first complete measurement of personal income for 2020 in its entirety, state personal income. And so before moving on to the forecast, I'd just like to take a minute to highlight how the composition of personal income have been impacted by the pandemic as it plays a continuing role in the evolution of our personal income growth forecasts. So here in this slide, the graph shows the level of total personal income by quarter for the second half of 2018 through the present, split up into 3 parts: wage and salary income, transfer payment income, and everything else. We use more detail than that in our forecast, but only those 3 are depicted here for simplicity. So a couple of things to note here. First is just to reiterate that this Rhode Island total personal income increased in the second quarter of last year, despite the dismal state of the economy at the time. Wage and salary disbursements, shown in green, did fall noticeably in that quarter, which was to be expected given the enormous declines in the employment counts. But surge in transfer payment income overwhelmed those declines in wages and salaries to propel overall personal income growth for that quarter solidly into positive territory. And the transfer payment component of personal income is where the various stimulus and income support measures shows up in the state personal income accounts. So those are the various unemployment benefit programs and household stimulus payments. And so subsequently, as we move through the rest of 2020, total personal income in the state gradually declined from quarter to quarter, even as wage and salary growth began to rebound. And so once again, movements in transfer income, this time some of an unwinding of some of the initial economic burst, the initial burst of economic stimulus overwhelmed the changes in wages and salaries and allowed total personal income to fall. So now I'll shift the focus to the Rhode Island forecast itself, beginning with the labor market outlook for the next 9 quarters. This forecast horizon covers from the end of available history through the end of 2023. And I'll just note here as well that with the change to discussing the forecast, I will now address the data in fiscal year terms. So our April forecast calls for employment growth to proceed at a steady yet decelerating pace over this 9-quarter time horizon as the state's recovery continues. Overall, quarterly gains are projected to average about 3.5% over this period for an overall net gain of about 37,000 jobs by the end of 2023. Meanwhile, we'll see the unemployment rate fall more than 3 percentage points from a current quarterly reading of 7.2% to slightly below 4%. However, it's really important to highlight how front-loaded most of this growth is, given a powerful combination of factors that include lower coronavirus infection counts relative to the winter surge, the hastening pace of the inoculation campaign, and the associated relaxation of containment measures. We expect to see a significant ramp up in growth for the next 2 quarters. In terms of employment, that means projected gains of more than 8% in the final quarter of fiscal 2021 and more than 6% to begin the first quarter of 2022 before growth begins to decelerate. Additionally, over those 2 quarters alone, our forecast calls for the state unemployment rate to drop by more than 2 percentage points. To put this projected employment growth surge and retreat of the unemployment rate into perspective, the graph on the right plots employment growth against the unemployment rate in the forecast. Shifting the focus quickly just to look across industries, the sector to report the largest overall employment gain by the end of 2023 is the professional, scientific, and technical services sector. This is one that was not hit as hard as many other sectors during the crash of the labor market last year. And so we're seeing a growth dynamic that goes beyond just recovering from disproportionate shares of losses here. Meanwhile, most of the other sectors projected to report the largest employment gains are indeed those most heavily impacted last year and still attempting to recover. This specifically covers accommodations and food services, which is projected to generate a net gain of 6,000 jobs. Healthcare projected to gain 4,300 jobs, and the other services sector, which is also projected to gain about 4,300 jobs. So just for reference here, I've just included a more detailed chart that spells out the full employment sector detail of the current Rhode Island forecast. So moving on to the next slide, here we have a summary table that provides a broader look at the nature of the recession recovery cycle for the next few years in our forecasts. Though 3 quarters of 2021 are still already in the books, I'll start there. For beginning with employment, so on the heels of a 3.9% drop in 2020, we see a similar decline projected for 2021, but another large negative there for 2021 is a bit misleading and perhaps counterintuitive given all the previous discussion of the improvement in the economy and a pending jump in employment growth projected for the closing quarter of that fiscal year. And this can simply be explained by the timing of the large quarterly swings in the data that can distort the annual values. So on that note, we can get a clearer picture of the 2020-2021 growth dynamics by looking at 4th quarter to 4th quarter growth. So to that end, I included an alternative version of this table on the next slide for reference that shows exactly that. By this measure, we actually see a 17% decline in 2020 and a forecasted gain of nearly 14% for 2021. So that really shows, more clearly shows the sizable turnaround in the labor market between those 2 years. Then beyond that, as we move into 2022, as the near-term surge in employment growth deteriorates, we see Q4 to Q4 employment growth slowing from nearly 14% to about 4%. And then as the forecast steps out a little further, we see growth slowing a little bit more into 2023 with the pace of employment gains dropping below the 2% threshold. And by this point, near the end of 2023, our forecasts have Rhode Island being very close to recouping its pre-pandemic level of employment. Meanwhile, just going back to the annual numbers here, the unemployment rate is shown as actually increasing from 6.2% in 2020 to more than 8% in 2021. However, again, as is the case for employment, the timing of the movements create a counterintuitive dynamic in these annual fiscal numbers that we focus on. By just returning again to the fourth quarter to fourth quarter perspective, the state saw a quarterly unemployment rate of nearly 14% in the final quarter of 2020, whereas the unemployment rate for the final quarter of 2021 is projected to be less than half of that, at about 6.4%. As the forecast moves into 2022 and 2023, the unemployment rate continues to fall, albeit at a decelerating pace, slipping to 4.3% at the end of 2022 to 3.8% in the final quarter of fiscal 2023. As for state output in the annual table, the forecast shows growth in real gross state product resuming in 2021, following up its near 3 percentage point decline in 2020 with a 1% gain in 2021. Beyond that, real GSP growth really takes off in 2022, with growth projected to exceed 5% for that year. Beyond that, along with employment growth, projected state GDP growth decelerates as we move into 2023, slowing to less than half of that pace for only 2.3% for that year. Next, moving on to state personal income, I present 3 related series in the table. Beginning with wage and salary income, we see a slight 0.2% decline in 2020, followed by a rebound of 3.7% growth in 2021. After that, wage salary income growth accelerates to nearly 6% in 2022, and during that time, much of that ramp up in growth is being driven by the underlying gains in employment. As the forecast moves out into 2023 and 2024, we see things decelerating in the face of slowing employment growth, though gains in the average annual wages paid to workers in the state are expected to prop up overall wage income growth at or above the 4.5% threshold for each of those 2 years. The second personal income series I'll highlight here is transfer payments, which again is the series that incorporates a lot of or almost all of the various income support measures that have been used throughout the pandemic recession experience. So in 2020, we see the full impact of all those support measures laid bare as transfer payment income grew nearly 28% on the year due to the surge during the fourth quarter of that year. And though transfer income did begin to wind back down in the next 2 quarters, as I highlighted during the historical data review, we see another year of annual growth in transfer payments in excess of 20% for 2021. And this is explained by another round of stimulus hitting the state personal income accounts in calendar Q1 of this year, fiscal 2020 Q3, and James discussed that new round of stimulus during his presentation. And so as we step further out, the unwinding of these stimulus impacts thereafter becomes apparent in the transfer income growth for 2022 and 2023, as we see a big negative and then flat, completely flat growth in 2023. The last concept I'll highlight here is personal consumption expenditures or consumer spending. So total consumer spending in Rhode Island fell, not surprisingly, during fiscal 2020, with most of the damage really being felt on the services side, due in large part to enormous declines in PCE in recreation services, which is the analog to arts, entertainment, and recreation employment, and also PCE in food services and accommodations. PCE in food services and accommodations imparted by the combination of consumer hesitancy during periods of high COVID-19 case rates, as well as the variety of containment policy measures. On the services side as well, healthcare services also took quite a hit, as many non-essential healthcare activities were postponed or either voluntarily or as a result of containment policy measures. So as we see in the table, our estimates indicate that growth will resume at a 2.6% pace for 2021 as a whole, before really accelerating to a peak of nearly 8% in 2022. Just as the services component was largely responsible for the weak number in 2020, the ramp up in services or the ramp up in overall consumer spending will be facilitated by the services sector, as the accelerating inoculation campaign and easing business restrictions paved the way for consumers to finally boost their spending on discretionary services. So to some extent, this would be anything in the hospitality industry, travel, things like that. And so for perspective, our forecast call for Rhode Island's consumer spending on services, excluding healthcare and housing, to grow at a nearly 24% annualized pace over the next 3 quarters, which actually outpaces the national average forecasted for that period by a modest margin. And then beyond that, as we move further out into the forecast, Rhode Island PCE growth will decelerate in step with the other major macroeconomic variables, slowing to 5.1% in 2023 and 4.5% by 2024. And finally, I'll just conclude this slide with a few key milestones for the forecast that are spelled out at the bottom of the slide. The first one being that non-farm employment is forecast to surpass its pre-COVID peak around the middle of fiscal 2024. Real gross state product is projected to surpass its pre-COVID peak early in 2022. And the state unemployment rate is projected to remain above 5% until mid-2022. So here's the first of 2 slides that I won't spend too much time on. This is just an updated version of the personal income composition graph that covers the annual fiscal year forecast values. And I just put this in here to once again illustrate the surge in transfer income, its subsequent unwinding, and the ultimate impacts on the path of the total personal income growth forecast. This also, I won't spend too much time here either. This is just a graph that gives a little bit more detail on the composition of consumer spending in the forecast. The focus here is the dominant role that consumer spending on services plays in the upcoming PCE forecast for the next few years. So moving on, the slide here provides some comparisons between the forecast values presented in this current vintage against what we presented in November 2020. So I'll just make a few key points here. First, I'll comment on employment growth. For 2021, growth is about 2 percentage points lower than last time. And aside from the impacts of data revision, this number is ultimately lower due to weaker growth in the fall and winter months as the coronavirus resurgence really took its toll. And effectively, that slowdown in growth really just pushed it out a little further and delayed it until subsequent quarters. And so we've now seen that reallocated primarily to the 2022 number, and hence that projected 5.1% growth rate. Beyond that, the growth is largely unchanged from last time. As for the unemployment rate, historical revisions did push things a little bit lower in 2020 and 2021 by about a half a percentage point due to the lower labor force count. And beyond that, we see a much bigger gap between the May and November forecasts in 2022 and 2023, where the unemployment rate is lower than last time, coinciding with the periods of higher employment growth. And on this slide here, I just have another set of comparisons between the forecast vintages. And the last thing I'll discuss here is personal income growth, notably the markup of 4.5 percentage points from 2.6% in November to 7.1% now. So some of this can be accounted for by stronger wage and salary growth shown in the table below, but the majority of this movement is again connected to the introduction of the second round of stimulus that is expected to hit the state personal income accounts for the third quarter of fiscal 2021, or last quarter. So I'll wrap up with just a brief mention of the alternative forecast scenarios, as I provided a set of those that accompany the April baseline forecast. So as these alternative scenarios are constructed at the U.S. level, really the key upside and downside assumptions are tied to assumptions about the path of coronavirus infections. On one hand, the pessimistic scenario assumes a significant fourth wave of COVID-19 infections, including more contagious strains of the virus that leads both consumers to turn cautious until more progress is made in the inoculation effort later in the summer. And also, this would likely be, or this is assumed to be associated with, again, reintroduction of containment measures to help contain the spread. And meanwhile, on the optimistic side, the assumption there is that the daily number of new cases dwindles quickly, allowing faster relaxation of business restrictions and consumer spending approaching pre-pandemic patterns earlier than assumed in the baseline, and more aggressively than in the baseline. And also the vaccination timeline continues to accelerate at a more rapid pace. So the remaining slides in the deck, which I won't go through here, are just included for reference, just spell out the results of the optimistic and pessimistic scenario runs for Rhode Island that correspond to the baseline I presented today. So that concludes what I have to present. I'll pass it back to open things up for any questions you have for me or James.
Thank you, Mike and James. I want to go to questions from the staff here. I'll start with the OMB on WebEx, if you guys have any specific questions you want to put out there.
I don't know, I'll start with something, although I know Matt's got some too. Hopefully I don't steal too many of his, us being in all different remote locations. I was curious, so, I mean, I know the population census change isn't, in your forecast and not in any of the older forecasts, as it's kind of too recent. But, it was basically double the population growth that was generally assumed. And we use, a lot of these historical variables, to help our models, predict revenue in the future. How, just conceptually, does this population growth increase over assumptions? How is that likely to change some of the significant data points from the past and what the forecast looks like from the future, from what's currently, listed in the baseline forecast?
So a couple things to consider there. The first thing is that, or I'd say the major thing to consider is first, how might this affect the forecast? Because it varies on what data you're talking about, but the Census 2020 data point that was just released is for April of last year. So many of those economic indicators, something like employment or GDP will likely be, that is sort of set in stone. So for those economic variables, those historical values may not change. As for what may happen to the forecast, both of population and other indicators, like again, employment or housing or personal income, GDP. The first thought would be, given how much stronger population growth is, it is indicated by the new census data point, we would expect to see a stronger population growth forecast once that's all done, which is, on one hand, a reasonable assumption to make, but we can't be completely certain at this point how the population forecast will ultimately come out, because the one thing that the issue with the census release is that all that gives us is the population total for that one period. We don't yet have the components of change so that's things like births, deaths, and net migration that really drive our population forecasts. And having that data at our disposal, which eventually will come out, will help us to understand what happened, why the estimates were so inaccurate, what was going on there. Without knowing that, it's hard to assess exactly how this will impact our forecasts as well. Another thing is that, with more data that comes out, the census data point is now inconsistent with all of the 2011 to 2019 population estimates from basically everything that covers since the last census that we generally have been relying on. So those will need to be revised by the Census Bureau at some point to reestablish consistency. So those numbers will change and give a different picture of what population has looked like over the last several years. That gives a new time series, complete, consistent, accurate time series that will also inform what the population forecasts will look like.
Is population, and I promise to lay off this after this, but so particularly in the historic variables, what in your own model does a change in population? What does a change in population like that? What variables in your forecast does that affect on more economic variables? I mean, obviously it affects population, but does that then impact employment growth, personal income? Like what sort of variables does it end up impacting across the board?
So I'll speak to just a few regional specific things for our models. James may have more to add for how that works in the U.S. macro model, given its additional detail. But my quick answer is that changes in population will affect household counts, which in turn household counts and household formations will affect housing starts volumes. Will ramp up, home building activity if household formation is higher in the forecast. That also tends to affect services employment, labor force. I know, like at the macro level, James, population will affect things like potential GDP and GDP forecast as well. But the big things for regional would be home construction and services employment, which would then feed into our personal income and output forecasts.
Yeah, this is James. I would just add very quickly that it really, again, at this point, it depends on the composition as well. Because if there's a big change in the number of prime age workers in the workforce, that greatly can affect productivity and long-term potential economic growth. And so it does depend on the composition. But then to reiterate at the macro level, things like housing starts, auto sales, healthcare spending, basically everything. Population goes a lot of places in the model. So.
Okay, thank you.
Matt, did you have a question as well?
Yeah, a couple questions for you guys. Thanks, Mike and James. So on the, I think it was slide 13 of the U.S. macro presentation, you have a nice breakdown of the kind of goods and services consumption forecast. It looks like you basically have goods consumption kind of getting back on trend pretty quickly after being fairly high during the pandemic period. I'm just curious, is there any kind of risk of potentially, that goods consumption dipping below trend, given people probably accelerated a lot of goods purchases recently during the pandemic?
Yes, I think there is. I think there is that risk. We have more of a gradual return to the normal composition, and the mirror image of that, of course, is the services, right? And as I mentioned, the certain parts of services, even though once it feels like the climate is back to quote unquote normal, I think that there's certain segments of the services spending that are going to be take more time, and that would be the things I mentioned, such as business travel, international travel, maybe even some type of sporting events and things like that. So you have to consider the mirror image, but in terms of the goods spending, I think especially on the durable goods side, I think that you might see certain types of categories where we dip below trend. So things like automobile sales, large durables, big ticket items that are, quasi investments that people have made. So I think, yes, there is the possibility, but overall for goods spending, when we add everything up, we see more of a gradual return to trend.
Thanks. This is a bit technical, but on the PPP loans, which I know there was a second draw on that, I guess how is that kind of counted in the forecast? I guess I'm thinking specifically about kind of corporate profits in that series. So where does that show up in your forecast?
Yeah, the PPP loans does show up as transfers to businesses, and so I think it's a subcomponent within income, the national income. But as far as corporate profits goes, it doesn't really flow into that. I don't believe.
Okay.
Yeah.
Yeah.
Sorry, I was just going to say it's a cost incurred by the federal government just to manage those processing fees. So it doesn't show up on the private sector to much extent. I don't believe. Mike, do you have something to add?
Well, I was just going to add on the state level where in the Rhode Island forecast, where the only place where that really will show up is because I believe there has been an assumption that James, correct me if I'm wrong, you guys have been assuming that a large portion of those loans would ultimately be forgiven, and so those forgiven PPP loans do show up in proprietors' income, non-farm and farm proprietors' income, mostly non-farm proprietors' income, but that would be the only place that they explicitly show up in the state forecast.
Got it. And one last question for James. In terms of the recent GDP numbers, I think they were released, was it yesterday? I guess I'm curious how those compare to your forecast for GDP.
Yeah, so they were stronger than what we expected, especially on the final demand portion of GDP, so namely consumer spending. So even with those, so flashing back to the high frequency credit card and debit card data that I showed you, it was even stronger than that was indicating. And so what that tells us is that the March was really a boom month, even more so than we expected. So a couple things: the stimulus, warmer weather, making up for February. So if you remember, February, at least in many parts of the country, namely Texas and other parts of the Midwest, weather definitely disrupted activity in February. So March was strong for payback because of warmer weather, the stimulus, and that's when vaccinations were really ramping up and instilled a lot of consumer confidence out there, and somewhat of a spending spree in March, especially. So I think the estimate for GDP in the first quarter was about a percentage, 1.5 percentage points higher than what our forecast was, and that will result in us revising up our second quarter forecast as well, because you get the carryover from a higher level of activity in March, will translate into higher activity in the second quarter as well. So, we'll be working through that over the next week or so. And early indications are that we'll be revising up our annual forecast by, perhaps up to 0.3 to 0.5 of a percentage point. So from about 6.2 to north of 6.5, between 6.5 and 7 for annual growth 2021.
And two questions from Mike. So you highlighted the forecasts. I think the strongest employment sector in terms of growth over the next couple of years was the professional, scientific, and technical services. I'm just curious for some commentary on why that sector in particular is forecasted for strong growth. I mean, it was not one of the hardest hit sectors during the pandemic. So I'm curious what's causing that, what kind of jobs those are. There was higher wage, lower wage jobs generally. I guess just some thoughts on that is helpful.
So that sector is a lot of, or primarily higher wage office jobs. Like that would be, accountants, lawyers, consultants, software engineers. Those are also primarily, like, a lot of the jobs in that sector are, or were the ones best suited to telecommuting, working remotely, which spared some damage during the worst of the recession. So the growth in that sector, or having that be a growth leader, will contribute strongly to overall personal income growth, wage, salary, income, being that they are high wage. As for a full explanation of why, or what's accounting for that particularly strong growth in that sector, I would have to follow up with you just to make sure I give you a complete explanation there. So sorry, I can't fully get through that now, but I can send you an email that spells that out a little more clearly.
Thanks, Mike. And the last question, which is a little broad, but in terms of the unique shape of the pandemic, recession, or recovery, are there any kind of, unique risks or either upsides or downsides for Rhode Island that you either were able to bake into the forecast, or maybe things that you aren't fully able to bake into the forecast, but you think are worth talking about?
Off the top of my head, I wouldn't say that there are necessarily specific upside or downside risks that are unique to Rhode Island. I mean, I will say one of the unique Rhode Island things that I can say, or that I can highlight, is that the return to peak date, is slower than the national average. And this is speaking in terms of specifically employment. It is going to take the state a little longer to recover all the way to its pre-pandemic levels. So that, primarily that's an effect on, that relates to the baseline forecast more than anything else. But again, off the top of my head, I don't have any Rhode Island specific risks that I could really speak to at the moment.
Okay. Well, that's all I have. Thanks, guys.
Okay, Steve.
Thanks, Sharon. In my non-economist brain, I kind of use CPI as a proxy for inflation. And James, I think I heard you say, you in the revisions, you expected inflation to be a bit higher. Looking at the economic forecast, CPI drops in both fiscal and calendar 21 and 22. And I'm just trying to marry those two things up, hoping you can offer some insight.
Yeah, so are you looking at the annual average CPI?
I was looking at on the economic forecast you provided for us on either a fiscal year or calendar year basis. Your November CPI numbers were higher than what you're coming in with now.
Yeah, so this includes obviously several months more of data. So up to this point, the incoming data have been rather weak in terms of the CPI. And so even though we're going to get a boost, presumably over the next several months, as many of these service sectors come back online and we see stronger spending, stronger demand, basically the calendar year numbers reflect softer incoming data up to this point. So it's partially saying more about what has already happened than what we expect to happen. Especially on the oil and gas front, oil prices, although they've picked up and gas prices have picked up, those things haven't really taken off to the extent that we anticipated. And so, again, it's saying partially about what's already happened to this point, rather than it is about what to expect going forward in terms of inflation.
Okay, thank you.
Do we have any other questions, Senate?
Just one more thing for me, Matt. Let me just think a little bit more about, think through the Rhode Island specific risk question a little bit more, and I can follow up with you if I have any thoughts when I get back to you about the employment sector growth question.
Okay, sounds good. Thanks, Mike.
Jonathan, do you have any more questions for the economist?
I don't.
And we don't appear to have any more here in room 35. If we could turn to the both the calendar and fiscal consensus forecast proposal from IHS. Does anyone have any specific questions on that, or are we in agreement that this will be the consensus forecast? I would also note that we do have the Department of Labor and Training provided in advance some additional unemployment information, which is also posted on the webpage if anyone needs any additional information. All right, it looks like we are in agreement that this represents the consensus forecast. And I thank James and Michael for joining us this morning. I would like to take a 5-minute break before we move on to the lottery testimony. If everybody would just stand by for about 5 minutes and we'll switch over the meeting and get started back up again. All right, we'll see you in 5. Thank you. Matt or Jonathan, are you on? Get started back. Thank you, Capital TV. You can go. Okay, great. We are back this morning to hear from the lottery first. And I will turn it over to Director Furcolo. Welcome.
Great. Thanks, Sharon, and committee members. So I'm joined this morning by Dan Serra, our finance administrator at the lottery, and by Anissa Colson, our controller. Dan will discuss the year-to-date sales report that Anissa sent out to the conferees early yesterday afternoon, and then we will answer any questions you may have. So, Dan?
Thank you, Director, and good morning, everyone. Our testimony today is on lottery receipts, and the first part of our presentation is our sales report for the 9 months ending March 31st, 2021, and this provides you with sales information in the form of narratives, tables, graphs for each lottery line of business as recorded for accounting purposes. And we generally provide that for your individual review, and we summarize this information on the first page of the financial section, which is page 27 in the presentation that Anissa sent out. And just to point out that the sales numbers will reflect the effects of the global pandemic, and at various dates during March of 2020, sporting events were canceled or postponed, the casinos were closed, and restaurants, bars, and taverns were also closed. And at various dates during June of 2020, there were phased reopenings, but at limited capacity, and this carried over into the new year beginning of July 1, 2020. Additionally, during the governor's pause, the casinos were closed for the period November 29th through December 21st of 2020. So if I may direct you to the first page of the financial section, which is page 27. This is a summary of changes in gross and net sales. And as you could see, for fiscal year 2021, traditional lottery is at a little over 160 million. This is ahead of the prior year at this time of 33.5 million, or almost 27%. The major increases coming in the line items for instant games, also the jackpot-driven games, and you can see iLottery there at the bottom. For the jackpot-driven games in fiscal year 21, we've had 3 jackpots for Powerball over 100 million, including a 731 million that was won on January 20th. Mega Millions jackpots, we had 3 over 100 million, including a $1 billion one that was won on January 22nd. And for the Wild Money, which became a daily draw in mid-July of 2020, we had 4 jackpots over 100,000, including a $440,000 jackpot that was hit on April 1st of this year. As regards the monitor games, they're down slightly year to year, 1.6 million behind the prior year at this time, or a little less than 3%. Video lottery and table games down significantly, and the sportsbook handle gross sales is up almost 36% over the prior year at this time. So overall, with the increases in traditional and what happened in video and table games and the increase in sports betting, it's almost 41 million gross revenue behind the prior year, just about 5%. On the net sales, the gross profit, which is gross sales less prizes, commissions, marketing expenses, and unclaimed recoveries for traditional lottery, up almost 25% at 8.463 million. Monitor games up almost 2%. Video lottery and table games down 34 and 36 respectively. And the sports book over 50% increase. Following that page, on page 28, we have the jackpots for you, as those affect revenues. And following that, we have our April estimate. We did have to estimate the last part of this week. This is the last day of the month, so we'll have those figures for you next week. But overall, on page 29, we anticipate the estimate being at $31.3 million transfer to the state's general fund for this month. And that breaks out on the following pages, starting on page 30. Almost $4 million from traditional lottery without monitor games. The next page is monitor games at 1.8%, $8 million. Video lottery on page 32, $23 million. Table games, about $818,000. And sportsbook transfer will be $1.7 million. The next section that we have for you is on video lottery. And that is on page 35. We have net terminal income by facility and an annual comparison. So we show you each week ending throughout the fiscal year. Following that is a section on table games. On page 36, we show you the net table game revenue and how that breaks out for each casino and for the towns, and then the lotteries, the state of Rhode Island share. There's also a table indicating the number of tables that are open and available. And the next section is sports betting, where we show you the accrual rate, the accrual payout, and the book revenue that we use for accounting purposes. And following that, we have a sheet on account registrations and activations. And that also shows you will indicate the percentage of mobile account registrations for Rhode Island, Mass, and Connecticut. And we'll be happy to answer any questions regarding any of the financial information that we presented.
Thank you, Dan. I'll go to OMB. Jonathan, do you have any questions for the lottery?
I don't. I'll defer to Matt. Brian, have any?
Yeah, I can jump in. I mean, I guess probably the big question on everyone's mind is the reopening timeline in terms of more BLTs being added and coming online, and also smokers. Maybe I'll start there.
Okay, so I'll take that one. So keep in mind, even with the constrictions that we have on the number of VLTs that are open and the number of table games that are open, we're not hitting our maximums, certainly in Lincoln, on a Saturday or Sunday. So we're getting in the low 80s, high 70% usage on the VLTs. So, I think that even if we had twice the number of machines operating and our capacity in Lincoln wasn't at 34%, I don't think we would see materially more visitors to the casinos. I think that people need to feel safe, and it's at that point they'll come and visit the casinos. The requirement to have distancing of 3 feet with plexiglass limits the number of VLTs that can operate at any one time, just due to the configurations that you can come up with. So, if you think about a phone booth, and if you put a chair in that phone booth and it points towards the phone, it's just hard to maneuver around. So we've done the best we can with the plexiglass and the various configurations. And remember that some machines are wider than others, so it's easier to get in and out of them. And some are smaller. At Tiverton, you have chairs that pull away from the machines, so it's easier to slip in and out. In Lincoln, they're attached to the VLTs, so you can't move that chair. So I think that if I look at the current reopening guidelines that has been put forth by the governor, bars have plexiglass being removed at the end of May. So I'm hopeful that the casinos will be allowed to incrementally remove plexiglass and allow more players to come in. At that point, and between now and the 28th of May, we would have work to do to modify the current layout to determine how many additional VLTs we could operate. I think as far as a full opening, Matt, I think that the governor has done a great job reopening as quickly as possible and as safely as possible. And I think if the current trends continue, I'd hope that we would have approval to reopen in total, midsummer. But that, there's a lot of variables that will affect that, our ability to achieve that milestone.
Yep, understood. In terms of poker, which I know is kind of a high touch activity, is there any thought on when poker can come back?
So I'm hopeful that will come back in early June. So Massachusetts, it is allowed, but not being played. And it's really around the economic reasons for the casinos. But, poker is not a highly profitable game for either the casino or the state. But it does bring in a group of players that aren't coming to the casino currently, and they're going down to the Connecticut casinos.
I have some more smaller scale questions, but I don't know if any questions from Sharon and Steve. I know this is kind of the big topic in terms of the reopening timeline.
All right, we'll switch over to Steve and then go back to you, Matt, if you still have some.
Thanks. I had a follow-up on the poker question. Director, you said you're hopeful for early June. What is that based on? Is that based on any kind of communications or just your own sense of where things may be headed, based on vaccination rates and other reopenings, or is it, conversations with other folks in the administration, or?
That would be based on, my reading of where trends are headed, and just kind of looking at, the reopening matrix put out by the administration for what happens on May 28th. And so, namely, that plexiglass goes away at bars, and so it seems like at that point it's reasonable to start to think that if we have plexiglass in place at our poker tables and people are masked, that it would be, a very safe activity to engage in at that point.
Gotcha. Thank you. And in terms of the status of the hotel and restaurants at the venues and then special events, what are happening on those fronts?
So I haven't heard anything on special events, but again, based on the matrix that was put forth last week by the governor, it would seem like events of 2,500 or more, if approved by the DBR and the town, could occur, certainly starting on the 28th of May. And as far as restaurants go, various restaurants are open. They're not all open, and it's really just due to volume of customers at this point. And as far as the hotels go, I think that again is based on the constriction of the number of games that are available. It just it doesn't make economic sense yet to open the hotels. I would see that midsummer time, early summertime, perhaps they would be open.
Thank you. And are the facilities running special promotions at this point, or is this kind of, they're always running promotions, so it's standard, or how's that working?
Yeah, so they are running promotions. They do have buses operating, not at the, not the number of buses pre-pandemic, and certainly we're not getting the volume of visitors per bus that we were getting pre-pandemic, but they are running, I think it's 4 buses a day, and getting 20, 25 people on those buses per trip, and those are largely people who have been given promotional points.
Thank you.
Certainly.
Mark, can you speak to how the Rhode Island casino usage may differ from other states at this point, where they are in their reopening and return to prior volume? At least neighboring states?
Certainly. The Connecticut casinos are a bit different just because they're tribal, so they're more open than we are, and have been pretty much all along. As I said, they are operating poker, and sometimes there's plexiglass in use, sometimes there's not, depends on the casino, depends on the table. Massachusetts is still limiting their capacity of fire code at 40%. And so while they may not have as many restrictions on like how their VLTs are laid out, their capacity is still limited at 40%. And to give you a flavor, our Lincoln facility is at 34.4%. If you just look at, front of the house employees plus guests, so that's 3,600 guests. And the Tiverton Casino is at 27.3% capacity if you include the front of the house employees, and that would be equal to 850 guests.
Okay, great, thank you.
Certainly.
Matt, do you want to go back to your questions now, if you still have them?
Yeah, thanks, Sharon. On sports betting, so I guess a couple questions, and this is not really a question, but on the activation slide, which is page 39 of the presentation, so obviously that has, I think, it jumped up in August due to the lack of requirement to show up in person, and then it's gone up, seems like, since then pretty steadily. Is there any kind of thought in terms of, is there a natural ceiling on this? Do we think this is going to keep growing for the near future?
I hope so, but I think that it will crescendo at some point. It's up 37% since we last testified in October, as far as activations go. And to give you a little more insight, so let's say there's about roughly 10,000 additional activated accounts since the last REC meeting. In March, we had 1,594 incremental registered accounts. So, it seems to be kind of straight lining still if you look at that 6-month period. And if you assume that 83% of those registered accounts will activate, they give you another 1,300 accounts active. So we're still not saturated. We haven't saturated the market yet, I would say, Matt. We still have upside. Now, Connecticut is looking to implement sports betting in the September timeframe. So you can see that I think 3.5% of our registered mobile customers, or our active mobile customers, are from Connecticut.
Any word on what Mass might do with sports betting?
Not yet. I mean, there's lots of bills and lots of talk, but nothing yet.
Okay. And last sports betting question. It seems like, if I do the math correctly, our hold percentage is pretty high compared to, I think typically we think about 5 to 6% is the industry average. I feel like we're more 9 to 10% range. Any sense of why that is, and if it might go back to more typical levels at some point?
So, I think that's just based on somewhat geography, based on how betting went on large items like the Super Bowl. But, we are at 10% for the year. We're at 9.4% last year. Those are very, very good hold percentages. So industry average would be 5.5 to 6.5. And so, it will settle there. We will have a year when it goes back there. And so on average, it's going to settle around, 6.5%. But, this is just kind of how things worked out based on how people bet and the games that were presented.
Makes sense. And 2 more questions. this might be a hard one to answer, but in terms of why we've seen a big increase in instant games year over year, any sense of why those are up so much? I was people buying more
Yeah.
cash tickets, but I'm just curious if there's any reason for that.
So, I mean, I think some of that is due to the games that we've put in play. I think some of it's due to marketing. And then I think some of it is due to the pandemic. So I think when the casinos shut, people played more instant games. And so I think it's a variety of factors. But what's interesting is I think our sales were up 9.4% last year. We're up 22% year to date. So if we can continue to hold that 22% next year, that's really yeoman's work. Keno is down, but I think that's because a lot of the venues where people play Keno have been closed or restricted. And I think that by the end of the year, Keno will be up year over year.
Last question on iLottery. I guess any sense of how that's performing compared to what we thought it might do?
So I think it's performing as we intended it would do. We're getting about 1,400 players a month, active players a month. Not seeing cannibalization. So as we had thought and the industry had seen that it really didn't. It was a different demographic than what's normally going in and playing Keno and instant tickets. And so based on what we're seeing, that's proven to be true here in Rhode Island also. iLottery sales only comprise about 2.4% of total lottery sales, so it's still a very small percent. And I think there's a lot of upside to iLottery still.
Thanks, Mark. That's all I have.
Certainly.
Okay, does anyone else have additional questions for the lottery? Steve.
Thank you. Just one more on Sportsbook on your page 39, where you have the chart of account registrations and activations. I was trying to look back on what you had given us back in November on this, and I couldn't come up with it. But the gap between the registration and activations, I would expect, would continue to get smaller. And obviously, in August, it really a lot of people activated their accounts when you could do it online. But it looks just from the eye test like that gap is widening a bit, and I wondered if you had any insight as to why more people might be registering but not then fully activating their accounts.
Yep. So there's a variety of tests you have to go through, to go from registering to activating. And so it may be that there's more players who are able to satisfactorily pass that test. Those tests, know your player is one that's an automated test to make sure that we understand who you are and we validate that the player who's registering is actually who they say they are. And then, it may be around getting funds funded and things like that people have difficulty funding an account for whatever reason. But you're right. Back in October when I testified, the activation to registration rate was 87%. And then at the current time, it's 83%. So that gap is a little bit wider, and I think it's because you're probably getting, around the margin, a different player at this point in the development of the product.
Okay, thank you. You spoke of some tests, in the system. Has anything changed in what you ask of registrants, since November?
Not that I'm aware of, no.
Okay, thank you.
Sure.
Okay, Jonathan, anyone else on your end need questions? I think we're good over here.
I think we're good.
Okay. Anything else, Mark, Dan, Anissa? Any other thoughts? before you leave us?
So just be aware that the Lucky for Life drawing will go to a nightly drawing commencing July 19th. And so as you think about that, and you think about Wild Money, which went to a nightly drawing last summer, the analogy may be not a one-to-one analogy there, because in the Wild Money game, the prize structure changed in addition to it going nightly. And that's not going to be the case with Lucky for Life. Additionally, Powerball is going to go to a Monday night drawing, so it'll be a 3-night week drawing. And the projection from Muscle is that that's probably worth about 5% of growth.
Oh, we got a new question. Thank you.
Thanks. So I'd forgotten, Lucky for Life is right now 2 days a week. Is that correct, Mark?
Yes.
Okay, so it'll be 7 days a week, and the prize structure will be the same.
The same.
Okay, thank you.
And quickly for Mark, when's Powerball go to a three-day a week? What is that?
August.
Okay, thank you for that additional information. I think that concludes. You mentioned you'd have the cleaned up monthlies out to us next week, and presumably any of the other data will come to us, the usual data, but a little bit before the end of the week. The updated video as much as you can, because we're doing that estimate on the 10th.
Yeah, we plan to have that to you by the end of day Wednesday.
Wednesday. Okay, great. Thank you. Okay, thank you for joining us, and we will now move on to Peter Keenan on Accounts and Control to talk to us about accruals. Everybody hopefully has a copy of Peter's presentation that is also posted on the website for the caseload Revenue and Caseload Conference. And so, Peter, you can begin your presentation. We have your materials. It's possible we're having some sound issues for Peter. Why don't we take a moment to make sure our technology is squared away, and we can get Accounts and Control on. All right, it looks like we have a video. So Peter, if, assuming you can hear me and
I can hear you fine.
Okay, you're on.
Right. So we sent over the 2 exhibits that we're going to talk about. I'll start with Exhibit 1, which is a unique phenomena this year that was result of the extended filing date in fiscal 20. I'm sure you'll recall we had the July 15th filing date. So we had to accrue back all of the payments that were received in July that related to the old fiscal year. So Exhibit 1 summarizes all those payments, and it summarizes them by tax type. And the important point here is that most of the payments, and the ones that are highlighted in green, were all recorded in the revenue report in the month of July or August of 2020. So, you know, when you're looking at the cash numbers, for example, when the revenue report comes out, hopefully on Monday for the month of April, these amounts would have to be adjusted out of the cash revenue report in order to get the accrual revenue for each of these categories. That's kind of a general comment. And, you know, this is a one-time thing. It has never happened before, presumably won't happen again unless the date is extended. And it is a very significant amount of money. So I want to emphasize that. So, you know, on Exhibit 1, we've listed each tax type and the amount that would have to be adjusted out of the cash numbers in order to get to an accrual number. And unlike other accruals where there's generally, you know, an accrual at the beginning of the year that reverses and an accrual at the end of the year that's booked, and a lot of times they pretty much offset one another. In this case, that will not be the case in that, you know, the tax due date this year for some entities was in mid-April and for individuals is in mid-May. So we won't have a July 15th accrual this year. So this is a significant impact on the cash revenue for fiscal 21. So I do want to emphasize a couple of things that are on page 2 of Exhibit 1 under the personal income tax category. You know, the first 3 items that are shaded in green, those are pretty much just standard amounts for, you know, final payments that were received in July and accrued back to June, estimated payments received back in July and accrued back to June, and also refunds that generally with the April 15th filing date, those refunds would have been paid out, let's say in May. With the July 15th filing date, the refunds were not paid out until shortly thereafter, July 15th. So we had to accrue those back to fiscal 20. The last 3 items, though, I do want to talk about. The first one, last year, you recall, we did make an additional accrual of $30.5 million. It had to do with pass-through entities and some legislation that was passed in June of 2019 that, you know, made some changes in the way taxpayers could make those payments. So there was an opinion that there had been some duplicate payments because of the transition. So we actually, you know, made I would say, a guesstimate of the amount of those duplicate payments, and we did set up an accrual last year, a liability for the repayment to the taxpayers. We're not planning to do any similar accrual this year because, again, that accrual was driven by the fact that last year was a transition year, and that same justification would not be present today for fiscal 21. So that 30 million will reverse, but there won't be a similar accrual for 21. The other item, which is right below that on page 2, deals with a provision in the CARES Act, which allowed for excess losses to be deducted. So the Office of Revenue Analysis had estimated the impact at the end of fiscal 20 was $18.79 million. And they also estimated an impact at the end of 21 of 10.3 million. So we will be accruing that 10.3 this year based on, the information we have in hand right now, and unless some statutory changes made at the state level. So that will be an accrual this year. So bottom line, this is a $163 million reduction of the cash revenue for fiscal 21 as recorded currently. Does anyone have any questions on that piece of the accrual?
So just to clarify, the only change from what was presented in November is this additional
Correct,
CARES
Sharon.
Act.
Yes. The only change is the addition of the 10.3 million. It's really not new information either because we did have it then, but, on further reflection and thought as we prepared for today's presentation, I felt that accrual should be added into the total accrual for fiscal 21.
Okay, and on the pass-through entities, we talked about that at length, although it's obviously quite a complicated item. So the pass-through entity item, the 30.5 million, that's non-recurring?
Yes, we believe that is non-recurring. Our thought process last year was this was a transition year. Last year was a transition year. There shouldn't be a similar transition this year because there were unique circumstances that existed in the latter part of 19 and fiscal 20. There's no reason to believe those same circumstances exist today. And honestly, even the 30.5 million was it was a very challenging estimate to make. But it was driven by the facts and circumstances that existed then, and those same facts and circumstances don't exist today. So it would be my opinion that no further accrual this year would be necessary, nor in any future year, unless, something changes in the legislative area.
Okay, so just wanted to confirm there's not going to be any additional payable booked against this?
No, there wouldn't be.
Okay, terrific, thank you. Any
No, well.
questions before he moves on? Okay, keep going, Peter, thank you.
Okay, so I'm going to go on to Exhibit 2. Exhibit 2 is, in normal years, this would be the one and only exhibit that we would present to the conferees. It's simply standard accruals. We show what the accrual was at the end of fiscal year 20 on June 30th. And then we show what we believe or estimate the accrual will be as of June 30th of 21. And many of these accruals are 5-year averages. So, a change in a particular year doesn't have a dramatic effect on the number because it's tempered by the 5-year averaging. So when you look down the line, I'm just going to talk about a couple of the items because many of them, there are not significant changes, which is generally what I would expect. So I'm just going to talk about 2 or 3 of them where there were significant changes, while we estimate there will be significant changes, because again, this is all an estimate of what we think June 30th will look like. So, the first one is under business corporation taxes, the refunds payable. We do see a slight decline in the accrual there. And the reason for that is that we've noticed that refunds in fiscal year 21 are down over fiscal year 20. So, when you bake that information into the average calculation, of course, it drives the average down. So that's the explanation for that decrease. It's $1.75 million. And I would expect, if the trend continues over the next few years, you'd probably see a further reduction in that accrual. So that's the reason for that one. The other items on page 1, they're minor changes, when you compare actual to estimate. So I'm going to, skip over those unless anyone has questions. I'll be happy to answer them. And go on to page 2. On page 2, we have personal income tax accrual and the inheritance tax accrual. So on personal income taxes, you'll notice that the refund payable accrual is up 16.97, let's call it 17 million. That's our estimate at this point. And I want to emphasize that one of the key elements in the estimate is the Revenue Estimating Conference in November projected $410 million of refunds for fiscal 21. We use that number in our calculation. So if you do adjust that number either up or down as part of your work in this conference, that would change our accrual. Now, it's not going to be a radical change because we use a 5-year average. So if you make a change, there will be an impact, but it presumably would not be significant. Also, the taxes receivable accrual, that went up almost the same amount as the refund payable accrual. So when you look at both of them, one went up 17 million, the other one up 15.3 million. So net, the accrual changed by $1.67 million, which really is very minor when you consider the volume of personal income tax revenue that the state collects in the course of an average year. One other thing about the tax receivable accrual is generally when we do this in late April, we've gone through the filing deadline. We have most of the final payment data. This year, of course, that is not the case because of the extended filing date for individuals. So we used our best estimate, but this number could change slightly once we tally up the May 15th or May 17th receipts. So it's subject to some slight change. The last item is the inheritance tax receivable. And our calculation on that is pretty straightforward. We take the estimated cash receipts for fiscal, in this case, fiscal 22, per the November Revenue Estimating Conference, and we accrue back to fiscal 21, 75% of that. So, when you compare that number, the cash receipts estimate is 49.1 million for fiscal 22. 75% of that is 36.9 million. So there's a significant increase there. That's by far the most significant change on this sheet. In effect, we pick up about a $10.3 million increase to revenue because of that accrual. So bottom line, when you look at all of these taxes, we've got a $9.6 million increase in revenue because of the accruals. But again, the vast majority of that is in the inheritance tax accrual at $10.3 million. So does anyone have any questions on any of these numbers or any other items that you'd like us to comment on?
Steve.
Thanks, Sharon. Peter, were any assumptions made around the treatment of PPP loans?
Steve, at this point, no.
Okay, thank you.
Are you welcome? And Steve, a lot of, just to follow up on that, hold on, my screensaver kicked in again here. Sorry for it.
We can see you.
You can see me, and I can't, unfortunately, I can't see you. I'm going to make another attempt here. It worked that time. A lot of our calculations are 5-year averages, like refunds payable. So things like the PPP program, you know, we definitely will take a look at it as we get closer to year end. But in general, because of the 5-year averaging, it would not tend to have a significant impact on any of these accruals.
Any questions, Jonathan or Matt or anyone else? Peter, can we just go back to that $30 million item?
Yes, Sharon.
It was a complicated discussion, and the exact details escape me, but as I recall, there was some sense that people might have overpaid.
Right.
Paid
I think
twice.
what my recollection is, Sharon, that some legislation was enacted in probably June or July of 19. And some of the taxpayers had made estimated payments, you know, as I think the schedule would be April and June. So if those payments preceded the legislation, then the next estimated payment date would be September. And I believe it was, it took, you know, a little bit of time to clarify, update, implement that new law. So by the time it was really effective, it was towards the end of calendar year 19. So a lot of estimated payments had been made using the, what's called the old method. So then, once the law was, once folks became aware of the law, they made similar payments using the new method. So there was clearly some duplication or the possibility of duplication. So we made our best, working jointly with the Division of Taxation, we made an estimate of what we thought that duplication might be. But my view of it was mainly because of what I call transition year, where, you know, we'd gone partway into calendar year 19, then the General Assembly enacted the law, and then the taxpayers reacted to that law towards the end of 19, and even in the early months of calendar year 20, I believe they were making payments, you know, towards their 2019 liability. So in general, you know, that was, and we saw it this way right from the beginning. We saw that as a one-time phenomena that should not, all other things being equal, repeat itself in the current fiscal year.
And so just, so a couple of things. I know here we observe that even if you change filing dates, certain businesses follow the same patterns, and it takes a year or so to catch up. Have you been in contact with taxation to kind of test your assumption on whether this is a one-time phenomenon?
We can talk to the folks in taxation on that. Yes, we will.
Okay.
And we can do that very soon, like today.
Okay, perfect. Thank you. I just, you know, sometimes it takes a while for changes to become more institutionalized, and I want to make sure we're capturing the money in the right place.
That's an excellent point, and we will follow up.
Okay, great. Thank you so much. Any other questions? Okay, I'm not seeing any. I appreciate you appearing before us. I'm sad to hear it may be the last time you're appearing before us. So certainly,
I'll miss these appearances.
not everybody says that, but we'll certainly miss having you.
So, but if you have any other follow-up questions over the next few days, by all means, just let us know. We'll be happy to respond.
Okay, thank you. Appreciate it.
You're welcome.
Okay, bye-bye. Okay, that concludes our agenda for today. Just as a reminder, we did not need to bring back any of the caseload participants for additional testimony, though under today's posting we have included the follow-up information they provided as requested. Our next meeting will be 1 o'clock on Monday with the Division of Taxation. If there's no other questions or issues, that will conclude this meeting. Thank you very much.